Hello everyone. In this video, I will explain some practice for chapter 10, including practice related to incremental cash flows, as well as practice on the cash flow from assets calculations over the life of the project. So the first practice is that six years ago, China exporters paid cash for a new packaging machine that cost 347,000 US dollar. 3 years later, the firm spent 14,300 US dollar on repairs and modification to this machine. And this machine now is fully depreciated and has just sat idly in a back corner of the shop for the past 7 months. The estimated value of the machine today is 157,500. The firm is considering using this machine in a new project. If it does so, what value should be assigned to this machine and included in the initial cost of the new project? So this is a question related to opportunity cost. This says that if you include this machine in this new project, you sacrifice a value, sacrifice the cash inflow for this machine, and you need to pick which is the cash flows you sacrificed by including this machine into the new project. So this is the first number, which is the initial cost of this machine 6 years before. 3 years ago, the firm spent 14,300 US dollar to repair it, and this is the last number is the market price. So let's think about it in the way that in the perspective of incremental cash flows. So when you make decisions, you accept the new project. Does this affect the cost of this machine? No. Whether you accept the new project or reject this new project, this cost cannot be recovered. This is the sunk cost for the new project. It's not an incremental cash flow. The second one, the money on the repairs and modifications to this machine. Whether you accept this new project or reject this new project, this cost cannot be recovered too. So this is also sunk cost, and it's non-incremental cash flow. And then finally, is this market price of this machine. If you accept this new project, you do not have this cash flow. You cannot sell it, both sell the machine together included in the new project. But if you reject this new project, the firm can receive these cash inflows. This cash inflow will be affected by the decision of acceptance of this new project. So this is an opportunity cost. We should include it in our analysis. And this is incremental cash flow. The second example, the custom tailored shirts is a specialty retailers offering t-shirts, sweatshirts, and caps. Its most recent annual sales consisted of 21,000 of t-shirts, 18,000 of sweatshirts, and 2,900 of caps. The company is adding polo shirt to the lineup and projects that this addition will result in sales next year of 18,000 of t-shirts, 16,000 of sweatshirts, 11,500 polo shirts, and 2,100 of caps. What sales amount should be used when evaluating these polo shirts? So first, we found that because of this new addition, the t-shirt sales decrease. This is a negative side effect. And the sweatshirts also has a decrease in sales. This is also negative sales effect, negative side effect. The caps, it's the sales of caps is also decreased. Those are also negative side effect. So when we evaluate the polo shirt project, we should also include those negative side effects into our analysis. So incremental cash flow, it's the cash flow that would only occur if the project is accepted. If we accepted this polo shirt business, this negative side effect will happen. So the total amount of addition, amount of cash flows bring by the polo shirt in this polo shirt cash inflows and the cash outflows, negative side effect caused by the addition of this polo shirt project. So the total incremental cash flow for this polo shirt is 5,700. The negative side effect, we also call it erosion. For t-shirt, it's negative $3,000. Sweatshirt is negative $2,000. Caps is negative 800. In total, it's negative $5,800. So the incremental cash flow we can write as the revenue of polo shirt minus the negative side effect, the cash outflow caused by the addition of this project is 5,700. These two numbers are equal to each other. So these numbers are equal to this number. So next one, Greenwood sells specialty equipment for mountain climbers. Its sales for last year include 387,000 tents, 718,000 of climbing gears. For next year, management has decided to sell specialty sleeping bags also. As a result of this change, the sales of projections for next year, you can see the tent, the sales actually increase. This is a positive side effect. And then the climbing gears sales also increase. This is also positive side effect. And then finally, the sales of sleeping bags. And they ask how much of the next year's sales are derived from the side effect of adding new product to its sales offerings. So this is a positive side effect. It's also called a synergy. For tent, the synergy effect is $24,000. For climbing gears, the synergy is $88,000 US. The total positive side effect is $112,000 US. The total incremental cash flow for adding this new project, accept this new project, is $240,000 US. Question 4. Floral Shops has a new project in mind that will increase the account receivables by 19,000, decrease the account payables by 4,000, increase fixed assets by 27,000, and decrease the inventory by 2,000. What's the amount the firm should use as the initial cash flow contributable to the net working capital when it analyzes this project? So it asks the contributable to the net working capital. So the net working capital equals to current assets minus current liabilities. changes in net working capital is equals to the changes in net current assets minus changes in current liabilities. So the changes in current assets basically is increase in accounts receivables. Changes in current liabilities and also decrease in inventory, so it's negative 2,000. Changes in current liabilities is this decrease in this account payables. So the changes in net working capital is 21,000. So which means you invest 21,000 US dollar in current assets in net working capital, and the cash flow from assets will decrease by 21,000 US dollar because you put money in the account receivables. You provide credit lines to your customers, which will basically is the cash outflows for you, and also you invest. You decrease the account payables, which basically is also a cash outflow because you pay more to your suppliers. Question 5. British Metals is reviewing its current accounts to determine how a proposed project might affect the account balance. The firm estimates the project will initially require 81,000 US dollar in additional current assets and 57,000 in additional current liabilities. The firm also estimates the project will require an additional 8,000 a year in current assets in each of the first 3 of the 4 years of this project. How much net working capital will the firm recoup at the end of the project, assuming that all net working capital can be recaptured. So for first t equal to 0, the changes in net working capital will be 81,000 US dollar. This is additional required additional current assets. And also they will have the 57,000 additional current liabilities. So the change in net working capital for t equal to 0 is 24,000. For t equal to 1 to t equal to 3, the change in net working capital is 8,000. Instead, it requires an additional 8,000 a year in current assets. So the total changes in net working capital over those 4 years will be the changes in net working capital at t equal to 0 plus the changes in net working capital over year 1 to year 3. The total changes in net working capital is 48,000. And at year 4, the firm will sell all the current assets, like the current assets is account receivables together with inventory. They will sell inventory. They will collect those money from their customer back. They also pay the additional current liabilities. So basically, the net changes in net working capital will be 0. So the total amount of net working capital that can be recouped will be a summation of all those changes in net working capital will be 48,000. Question 6 is that a 9-year project is expected to generate annual revenues of 137,800, variable cost, fixed cost, annual depreciation, tax rate, then what's the annual operating cash flows? So earnings before interest and taxes equals to revenue minus variable cost minus fixed cost minus depreciation. We get this number. And operating cash flow will equals to earnings before interest and tax, add back depreciation and minus tax. So it will be add back depreciation, and the tax is based on EBIT. So the operating cash flow equals to 37,162. Question 7. The blue Lango is is considering a project with a 5-year life. The project requires 32,000 of fixed assets that are classified as 5-year property for modified accelerated recovery system. The variable cost equals to 67% of the sales. Fixed costs are 12,600 and the tax rate is 34%. Then what's the operating cost for year 4? So for year 4, the sales is 38,900 and the MACRS rate, depreciation rate is 11.52% of these fixed assets. Remember, when we calculated the depreciation, we use the depreciation rate times the fixed assets price. So EBIT equals to sales minus variable cost minus fixed cost minus depreciation. So this is the sales minus the variable cost is 67% of the sales minus the fixed assets and minus the depreciation. Depreciation is the fixed asset price times the depreciation rate. So we found the EBIT is a negative number. The operating cash flow is the EBIT add back depreciation and minus tax. And because the EBIT is negative, we actually get a tax credit. So finally, cash flow from assets for year 4 is 1,410. Question 8. 3 years ago, StockTech purchased some 5-year MACRS properties, and the price for these fixed assets is 82,600. Today, it sells the property for 31,500. How much tax the firm owns on this sale if the tax rate is 34%? So the 5-year MACRS depreciation rate is given. This is year 1, 2, 3, 4, 5, 6. So the first 4 years, the depreciation rate is this. It's a summation of these 3 rate. So remember the after-tax salvage value is this. So we know the salvage value is 30. So if we want to find out the tax, this is the tax paid. The salvage value is 31,500. Tax rate is 34. So the only thing we need to calculate is the book value. Book value will equals to the initial cost minus the summation of the depreciation. The initial cost is this, and the summation of depreciation over the first 3 years will be this property initial cost times the first 3 years depreciation rate and sum it up. So basically, we can just collect the common term. So let me just break this down. For year first, your depreciation equals to 82,600 times 20%. The second year, the depreciation equals to 82,600 times 32%. The third year, the depreciation equals to 82,600 times 19.2%. So the summation of those 3 equals to 82,600 times, we can collect the common term plus 32% plus 19.2%. This is what we get here. So we found the book value is 20,000 23,788.8, and the tax is 2,600. Is based on the difference between the salvage value and book value is 2,621.81. Question 9. The sausage hunt is looking at a new sausage system with an installed cost of, this is the cost, and this cost will depreciate straight line to 0. So remember the last year book value is 0 over the project's 4-year life, at the end of which the sausage system can be scrapped for 25,000. This is the market price. And this sausage system will save the firm $69,000 per year in pre-tax operating cost, and the system requires an initial investment in the net working capital, and which will be recouped at the end of the project. If the tax rate is 34%, estimate the cash flow from assets for this project. So we first calculate the operating cash flow. The incremental cash flow is a cost saved. It's 69,000. The depreciation will be the cost because we depreciate to 0. So it's this minus 0. It's just itself divided by 4. Each year the depreciation is 46,850. Earnings before interest and taxes will be the difference between the incremental cash flow and the depreciation. And the operating cash flow will be EBIT add back depreciation and minus tax. The tax is based on EBIT, so it's 61,469. Then we need to determine the changes in net working capital. At t equal to 0 is that there is an initial investment in net working capital of 9,000. So basically it changes from $0 to 9,000. So the change in net working capital is 9,000. For t equal to 4 is that it will recoup at the project end. It will change from 9,000 to 0. So it's negative 9,000. Net capital spending t equal to 0, that is the cash outflow for the capital for this project, that's the capital expenditure. For t equal to 4, the salvage value is 25,000. The after-tax salvage value will be this market price minus, remember the book value is 0, so the tax will be based on the market price. So the after-tax salvage value is 16,500. So we put it in the table here. So the cost saved, which is the incremental cash flow, is 69,000. Depreciation each year is 46,850. And EBIT for each year, tax and add back, subtract tax, add back depreciation is the operating cash flow. Change in net working capital for t equal to 0 is 9,000, and the net capital spending is 187,400. So the cash flow from assets for t equal to 0 is negative 196,400. And for t equal to 1 to 3, there's no changes in net working capital and no net capital spending. So the cash flow from assets just equals to operating cash flow. And for t equal to 4, so this is operating cash flow. The changes in net working capital is negative. So minus a negative actually is add a positive number. Net capital spending, because it's a capital spending is a cash outflow. So a negative net capital spending means it's a cash inflow. So minus a negative number, it's a positive number again. So then when the cash flow from assets for year 4 is 86,969. Question 10. GL call is contemplated contemplating the purchase of a new computer-based order entry system. The system will be depreciated straight line to zero over the project's 6-year life. So we know the net capital spending for T equal to 0 is this number, and the project has a 6-year life. It depreciated to 0. The pre-tax resale value after 6 years, 215,000. The system will save this amount of money before taxes per year in order processing costs, and will reduce the working capital. So at T equal to 0, at the beginning, it will reduce the net working capital by 46,000 US dollars. So we can think it becomes from 0 to negative 46,000. So the changes in net working capital at T equal to 0 actually is negative 46,000. And then the working capital will revert back to normal at the end of the project. So which means it will change from negative 46,000 to 0. So changes in net working capital at T equal to 4, at T equal to 6 equals to positive 46,000 US dollars. And the tax rate is 34%. So at T equal to 0, there's no operating cash flow, and the cash flow from assets for T equal to 0. Remember, the change in net working capital is a negative number, minus a negative number is positive number. T equal 1 to T equal to 6 depreciation. Earnings before interest and taxes will be the incremental cash flow minus the depreciation. It's 76,666.7. Operating cash flow is EBIT minus tax add back depreciation. Tax is based on EBIT. So it's 121,933.33. So we found the operating cash flow for year 1 to year 6 is this number. The cash flow from assets from year 1 to year 5 is just equal to operating cash flow because there's no net capital spending, no changes in net working capital over the 5 years. For year 6, change in net working capital is positive 46,000. After tax salvage value is this market price minus the tax. Tax equals to tax rate times market value minus book value. Book value equals to 0. So the after tax salvage value is 141,900. So then we remember this is minus a negative number. Negative net capital expending means cash inflows. Or we can just write here is plus 141,900 because we receive this. This is cash inflow. And then that's the cash flow from asset for year 6. So if we plot this, plot a timeline for this project, the cash flow is at the beginning, the firm has to invest 382,000 US dollars. And over year 1 to year 5, each year the firm will receive $121,933. And at year 6, the firm will receive 217,833 US dollars. Okay, that is chapter 10, and next video I will start talk about chapter 11. Thank you for watching. Bye.